Well, it's interesting. This all started with Tesla, too, and Bitcoin. Bitcoin in 2015, Tesla 2014-15, and we had what seemed like a crazy estimate out there. But it was all modeled, very data-driven. And I think what the market's missing is they are not focusing on something called Wright's Law. Wright's Law is a relative of Moore's Law. Moore's Law is a function of time. Wright's Law is a function of units, and it says for every cumulative doubling in the number of units produced, costs decline at a consistent rate. Theodore Wright was a civil aeronautics engineer, and he observed during the early days of airplane manufacturing this law. And so if you and back then I think the cost, Sam, correct me if I'm wrong, is 10% roughly for every cumulative doubling in the number of airplanes manufactured. You fast forward to today, and in robotics, industrial robotics, that number is 50%. If you look at battery technology, that number is 28%. DNA sequencing, which is, I know, not in this room, but 40%, 28% for short read. So these are massive deflationary trends evolving all at the same time. So we're going to see S-curves feeding S-curves, and I think we'll see it in space especially. The capital will be there once, and now I'm saying both in the public and private market. I think in the private market what we're seeing, and this is a throwback to that 2018 conference, which was, we remember one VC venture capital leader after another getting up on stage and saying, oh, we would never invest in this. This is too high fixed cost. This is too long term. Or well, there were many excuses. And so it's been very interesting. There is a lot of capital moving into the asset light part of the business, and still maybe an aversion to the more hardware centric. But we do think that will change over time. So innovation generally, starting in February of 21, that was our peak. Innovation has been, for want of a better word, trashed. If you look at our performance, our flagship's performance, from the low in COVID to the peak in February of 21, that was 360% increase. Innovation solves problems. We had a lot of problems through the coronavirus. Innovation solves problems. We were rewarded accordingly. Since then, peak to trough, when we hit our trough, thank goodness we're past it, down 75%. Why? Inflation and interest rates. So there is this, and it's really interesting to be here, Walmart territory, because I think we're learning a lot from the retailers now. The fear of rising interest rates and inflation out of control has gripped the market. And of course, and that's the equity market. If you look at the fixed income market, it does not agree with this. Yeah. The 10-year Treasury bond yield is 3%. That instrument should be one of the most responsive to inflation fears, right? So 3%, which suggests GDP growth 3 to 4% during the next 10 years. So it's not being corroborated by the fixed income markets. And I don't think that we are in a period where we can't extricate ourselves from this. In fact, the inventory stories are a very good example of why inflation has become a problem. You know, the scrambling to bring more and more inventory to satisfy demand, stay-at-home demand, went into overdrive, and I believe the narrative in the last year, inflation, gave purchasing managers this idea that, okay, what's the worst that could happen if I build inventories? The worst that could happen is that I'm able to deliver inventory profits, sell at a higher price. Well, that's not going to happen. That's not going to happen. When we see, I've never seen inventory surges like this in my career, and I've been around for a long time. So 33% at Walmart, 42% at Target, 74% at, 50% at Kohl's. So very broad-based. And so I think we're going to see a lot of discounting. And what's beginning to happen now, just at the margin, and we're seeing it because our strategy is now starting to outperform the rest of the market. I've never been in a market where the market has gone to new highs and we are hitting lows. I've never been in a market. So there's been, and it hasn't been supported by the fixed income market. So we'll see what happens. I think investors trust us. They know we're doing the work. We're giving our research away. We're beginning to give our models away. We have Tesla up on GitHub. Today or tomorrow, we're going to publish another one, which I can't say until after the close. We are going to play the ground war here to help people understand what during the next 5 years is going to happen to these companies. So your original question was, why are they staying with us? They trust us. They trust our research. We're doing research that others are not doing. We're sharing it with everyone, both the top-down, modeling, as well as now the bottom-up modeling. And we want people, investors, skeptics, to poke holes into our models. You
welcome that?
Oh yeah, we leave the variables open. If you think we're crazy on this assumption, you change it then and see what the price target is. Let's see what the sensitivity to each assumption is. And I think our clients really like that. And I also will say, we see this, I'm going to say it's across the board, but especially young people, they know that we are researching the future. We are researching the future. If you look at what has happened to our industry, it really lost the plot after the tech and telecom bust and then the 08-09 meltdown. We had this tremendous risk aversion, business risk, career risk, and a movement towards passive and benchmark style investing. And I have been quoted as saying, and I know Eric Balchuna said, he would disagree with this because he thinks it's actually a good thing that all of this passive and benchmark has happened for us. And I agree with that to some extent, but in terms of allocating capital to its highest and best use, I don't think looking backwards is going to work. So I'm really thinking about the competitiveness of the United States when I say that, not about us. Yes, I think we will shine because we are looking at the future, and the future is very bright for all kinds of reasons. I think it is seeping into the investor's mind is, wait a minute, are we right on this inflation call? They felt so right because supply chain issues extended for such a long time. Then Russia invades Ukraine, of course, monetary and fiscal policy had been so stimulative. But as I've said many times, we think the greater risk, by far, is deflation. Deflation cyclically.
But you're talking over a longer time horizon.
I'm talking about now, too, because I think this inventory issue highlights the cyclical reason we've been saying we think inflation will unravel. The secular deflation story is very powerful, and as EVs and autonomous mobility of all stripes starts becoming a bigger base in the economy, that deflationary pull is going to be aggregated because, again, these are convergences between and among different technologies that are all on their own deflationary cost curves. Yes, and I'm not saying investors should put 100% of their equity exposure into the ARC. Now, is my own personal portfolio like that? Yes, but I wouldn't suggest it for most because this is a truly volatile strategy. So we have a study up on our site which says if you allocate 5 to 10% of your equity allocation to this kind of strategy, innovation, solely innovation, you will increase your returns per unit of risk over a 5-year period. And very important is 5-year period. We are the closest you'll find to a venture capital fund in the public equity markets. And of course, we're acting like it. In fact, we led this VC down round. The VC down rounds that we're seeing now were led by the public markets. Now, I don't think the public markets have this right at all. I think that we are in bargain basement territory in terms, if you give us a 5-year investment time horizon, we are a deep value portfolio. I think the private markets are closer to right, but there was a wall of money pushing in and there was some bad behavior, so we are in a reset here. I don't think we'll go down to public market valuations. I think that we'll see kind of an adjustment both ways. So we pay attention to a site called Metaculus, which basically anyone can put their forecasts in there, but they are basically graded over time. And if you look at since OpenAI released DALI 2, foundation model in AI,